Hi, thanks so much for tuning in. You're watching BQ Prime. This is the Mutual Fund Show, and my name is Alex Matthew. This conversation is set up to talk about passive investing and specifically with regard to equity. Now, it's only been a few years that we've seen the growth of passive investing in India with regard to mutual funds, and it's already grown in a very big way. Part of that has to do with the fund flows from the pension fund into passive, but there's also a lot of adoption from investors like yourself. We're going to talk about how far that has come. And then the second leg of the conversation, we'll talk about how you can incorporate the various products that are currently available and how they can fit the requirements that you have. The first leg of the conversation has to do with what the industry has done over the past few years and what the implications of that are. Joining me to talk about that is Pratik Oswal, who is the head of passive funds at Motilal Oswal. Pratik, thanks so much for taking the time. Let's start with this, right? Because I remember very distinctly, we spoke just about 3.5, 4 years back. We did a podcast that spoke about passive as this new opportunity for investors to get into, and it's come quite a while, quite a distance from that point. How would you describe that journey so far, and where do we stand right now?
Yeah, hi Alex. Thanks for having me here. Um, yeah, so I actually do remember a conversation that we had 3.5 years ago, and I think we're still somewhat in the same phase where I think one of the things that we as an AMC and also a lot of other sort of mutual fund houses are still talking about awareness. I think even though we've seen a lot of funds flow into passive funds over the last 5 to 7 years' time. To give some numbers, the overall AUM of passive funds were about 20,000 crore in 2015 or 2016, and that's grown to almost 7.6 lakh crore, which is now approximately 17 to 18% of the overall mutual fund AUM from about 1.5 2%. So not only has it grown in size, it's also grown in market share. Um, and I think not only when people think about passive funds, they think about Nifty, Sensex, but we've seen creation of new categories in this era of the last 5 years. You did not have fixed income passive funds 5 years ago. That's a 1 lakh crore industry today. You did not see much of commodities. You have gold and silver ETFs. You did not see international funds 5 years ago. Now that's about 60, 70,000 crore in assets. So I think what you see in the industry is an explosion in a number of categories, number of funds, and also in terms of the number of AUM that has come into the passive funds over the last 5 years. However, having said that, most of the AUM that is coming in through family offices, mostly institutional, so from pension funds. But increasingly over the last couple of years, you are seeing a lot more interest coming in from investors from all sides. I think awareness is still the barrier, but I do think that over time, we've seen less and less of that problem.
One of the reasons why I want to have this conversation with you is that you guys did an interesting study not too long back where you asked a sample of investors what their approach to investing is, and that threw up a few very interesting results. So what can you tell us about the headline from that? One, more people are obviously aware of passive, but why do they get into it? To what extent do they get into it, and what products do they choose?
Yeah. So we actually, did this very interesting survey, and we keep on doing surveys to, understand investor preferences and how they sort of change over time. We obviously, want to be more customer centric. And what's really interesting is that, we did this survey, towards the start of the year, which we ran for about 4 months. We had about 3 to 4 thousand responses in that survey. And what is interesting is that, and these are targeted towards mutual fund investors, not only from our AMC, but from across the industry. And what we saw was there is a lot more the awareness, which was lacking. When we had the podcast 3 years ago, is currently not is a lot more than it used to be. So approximately 60% plus of the participants said that they've invested in at least one passive fund, and most of them are looking at increasing their allocation towards passive funds going forward. Not only that, there are obviously categories like factor funds where people are now slowly being aware of, and also most people in this segment are looking to increase their allocation towards passive funds over the next 12 months. So I think the good thing is that majority of the investor base, at least investor base that we surveyed, and also overall from the end investor's point of view, passive funds are sort of making the cut today from a retail perspective, and people are looking at it from a much stronger lens. I think what has driven demand towards passive funds, from the investors' perspective, there are three main reasons to I think what investors have said. So in the survey, the number one is low cost. I think passive funds are popular because more of your money is invested in the underlying funds because the expense ratio tends to be much lower. So low cost is the number one reason. And apart from that, also simplicity and market returns is something which is also equally almost as important as low cost. So I think what we've seen in passive funds, and we have a host of passive funds today. There are about 170, 180 index funds, ETFs launched. But what we've seen is that the simpler products are getting most of the AUMs. So I think simplicity and also low cost is one of the main reasons to why we're seeing so much interest in index funds, ETFs, at least over the last couple of years.
I think you also asked about the ideal time frame that people intend to hold these for. I'm curious about the responses that you got there.
Yeah, exactly. So what's this is actually a very important thing because usually a lot of people tend to have trading strategies when they're buying bank nifty or selling nifty. But I think in our survey, what was really sort of the good stuff is that most of our respondents were actually looking at from a 3-year plus perspective. So I think a lot of people are looking at passive funds not from a trading mindset but from an investing mindset, which I think is an excellent choice. And also number two is 3 out of 4 respondents were actually looking at playing this space via SIPs, which again is great because SIPs are great for long-term wealth creation. You don't have to worry about time in the markets and all of that. So I think the combination of the fact that most people are looking at it from an investing lens, plus that people are looking at it from an SIP lens is actually a great way. It's quite encouraging the way people are using passive funds.
My final point to you, or my question to you, is about the products that are currently available and that are in the works. Some of your peers or some of your soon-to-be peers intend to be primarily passive oriented. So that would entail, I think, a lot more products in this space. And you mentioned at the start that people gravitate to a few funds or fund types because of the simplicity of it. But there's a lot more that you can get in terms of nuance. And if you look at, say, the US, where you see more than 50% of investments or AUM in passive, there are a lot of strategies that are available that are not currently in play here. What current strategies do you think are interesting to talk about?
Yeah, looking at the US, we also feel that simpler products will get majority of the AUM. If you think about an index fund, the first thing that comes to most people's minds is the S&P 500 fund, which is very popular in the US. I think 3 out of 4 of the largest funds in the world are S&P 500 index funds. So that's how popular that fund is. And I think even though obviously majority of the AUM is there, just the size of the market is big enough so that there are many other billion-dollar plus funds in the marketplace. So I think the way I think most AMCs, including ours, looks at passive funds is number one is building blocks for asset allocation, and second is categories. I think most people think of index funds, ETFs as Sensex and Nifty, but actually you can have unlimited amount of passive funds. Most of these big AMCs in the US have hundreds of index fund ETFs under their umbrella, and we'll probably see similar sort of trends coming in India over the next say 5 to 10 years time. I also agree that the whole idea about passive is to be simple, but we've as an industry we tend to overcomplicate a lot of things. So there's a lot of factor funds and mid cap funds, small cap funds, and multi cap funds and micro cap funds. So I think in terms of choice, there is a lot more choice than it was 5 years ago. And as an investor, I think the idea is that you're catering to different types of investors. You're catering to a sophisticated investor, a retail investor, someone who's looking for a different type of risk profile. So I think because we're catering to a varied sort of set of investors, I think it's this category-based approach is something that will probably stand out in India. Having said that, most of the AUM should still sort of be in those simpler products your large caps, multi caps, sort of funds, or your fixed income or your gold funds, where majority of the money tends to go.
Absolutely. All right. So that sets the context, I think, perfectly for the second leg of this conversation. Pratik, thank you so much for joining and for taking the time and for setting the platform for us. Now, you've kind of understood how far the passive journey has gone for the Indian mutual fund industry. But what does this mean for you, the investor? How should you incorporate these strategies into your own portfolio? To talk about this, I have two guests joining in. We've got Santosh Joseph, who's the founder of a Germinate Investor, and Anant Ladha, who's the founder of Invest Aaj for Kal. Thank you so much, gentlemen, for taking the time. And you were listening to the first part of the conversation where we've kind of set the context and said, look, this segment of the industry has grown quite significantly. But how does one look at passive to incorporate it? It's not necessarily something that should replace active completely. And I think we've spoken about that in the past as well. How would you use it in combination? I'll start with you, Santosh.
So essentially, when one looks at the difference between the active and the passive, I think clearly it's the ease for the investors. Now today we've grown with the new clutch of investors where we've gone from DIY, do it yourself, to serve yourself. Now this product comes in handy for people who like to be invested in equity, right? And at some level are a little reticent to make a decision about should I go for active or passive, but still want to get their feet wet. Now, this is a great way to start off. So therefore, you don't have to really worry about should I do it or not do it. Here an option is do both if you can. Eventually, you will graduate to either go full on active or you're being happy with passive.
Interesting. Anant, I'll come to you on the choice of product here because like anything else in the investing space, you have to choose what fits the bill for you. And I think a lot of people gravitate when they're starting to the large cap funds, but there are several options across the spectrum. So how do you choose?
See, I personally feel that index fund are perfect for no-nothing investor who don't want to take anyone's help, be it RIAs or be it mutual fund distributors. For example, if you want to invest in US market and you are not having much knowledge about US market, then probably index fund is a better option which you have to invest your money. If we talk about India, I feel right now we still have a lot of scope in mid-cap and small-cap space where active funds will probably outperform for near future, which we can see. So for me, index fund in India is mainly focused towards the large cap space. Maybe I am more attracted towards Nifty 50 equal weight funds because I feel that equally dividing your corpus in 50 stock is something which is making more sense to me. Even data suggests so that whenever we see 5-year rolling return of any given time period, Nifty 50 equal weight fund has delivered more than 6% returns, which is kind of, we can say that you have outperformed or equally performed as compared to your FDs, even in worst of the times. So this is one category which is attracting me the most right now. Other than that, especially in the mid-cap space and the small-cap space, I am more attracted towards the mutual funds and active mutual funds.
Okay, fair enough. When it comes to the large cap space, so Santosh, it's an interesting conundrum, right? We had in the first part of the conversation as well talked about Sensex fund or a Nifty 50 fund. Is that sufficient in the large cap space? Because I've also heard proponents of saying, you should take Nifty 50, but you can also perhaps take the Nifty next 50 to kind of balance it out and to have a reasonable allocation towards that large cap space.
So yeah, as you go down that path of choosing between Nifty equal 50 or the Nifty next 50, I'll just share some numbers for you. When you take within the Nifty, the top 10 stocks in Nifty alone constitute to 60% of Nifty. Now, by 50 stocks being in Nifty, the top 10 should be 20%, whereas their weightages are 60%. You see the skew. Therefore, equal Nifty 50 may give you a fair chance because the top guy has got close to 10% in the Nifty and the bottom 50th guy has got about 0.5%. You see the skew, and hopefully you're hoping that the guy at the bottom also get a fair chance to perform to take Nifty forward. Now, therefore, equal Nifty 50 finds a little more merit than just Nifty for the people who are happy not to make a decision. Now, I'd like to extrapolate the thought and say, I like the Nifty 500. It's a beautiful universe, the universe in which most mutual funds operate, active funds, not so active funds, and even the passive funds. When you take the breakup, 76% is large cap, 34% is mid and small cap. There again, survival of the fittest. That story plays out beautifully. Again, this is for people who say, I don't need anybody. I want to get my investment theses into the equities, but I do not know where. Whether you play equal 50, next 50, or the Nifty 500, you got a beautiful play. In fact, I would root for a Nifty 500 if at all you want to go for active funds against the choice of a good active fund.
Oh, so Nifty 500 as opposed to. So here's the thing. I started this conversation with you, gentlemen, to say that perhaps the best solution is a combination of both worlds, because Anant has pointed out, and with due merit to that statement, the mid cap and the large cap fund managers have in fact managed to beat passives to a large extent. But you, Santosh, are saying that you would argue, or you would bat for a Nifty 500 index fund against quite a few actively managed funds.
So
I
it's
will
tough.
first, yeah.
See, the reason is the numbers are stacked against you. When you
Yeah.
look at the universe of mid cap and small cap, even an average fund manager will beat the index. I think we're all agreeing on that. Now, when you want to build a combination of large cap, mid cap, small cap, now it will be silly to say that for large cap and some bit of component I'll do in passive, and for small cap and mid cap I'll do in active. Then that's when Nifty 500 comes into play. I am saying preferably play the active space. If at all you're so stuck up about saying no, I'd like to play only passive, then the 500 is a better choice. So I think that's how I like to put it.
So that's a good qualification. Now, having said that, Anant, you pointed out in the mid cap and the large cap space. Now, when somebody, so assume that this is a hypothetical scenario, one of our viewers joining in has no knowledge of investing, wants to keep it simple, cost is low, and that is something that we've also established. What would your first suggestion be? You need to cut your teeth. So therefore, I would think that a large cap Nifty 50, like you pointed out, equal weight fund. And then how do you want to nuance that? What kind of split should you ideally have?
See, we should understand firstly that whether it is investing or health matters, everything is subjective. Sure. We cannot have a single principle for everyone. For example, I'll just give you a very practical example. In US, it is recommended that you should not consume a lot of ghee. It is not good for your health in terms of US. But when we come to India, we consume a lot of ghee, and it is actually good for our health because of the climatic condition which we have in India. In the same way, investing cannot be simple A, B, C. It has to be subjective depending upon your own personal taste and your own personal mindset. If you talk about the initial starting point and you don't want to take anyone's advice or anyone's help, I feel that DSP Nifty 50 equal weight fund is a decent fund having a tracking error of 0.05%, which is reasonable, and a decent fund to start off, and it can be your starting point. If you want to invest in international market, S&P 500 index fund, be it of Motilal Oswal or be it of HDFC, it's a good starting point, and this is where you can start your journey. Eventually, I feel small cap space and mid cap space, as I earlier also mentioned, you have a lot of scope of outperforming the benchmark, and you will eventually need to have some knowledge about active funds or hire a distributor or an RIA and take his help and invest accordingly. At the same time, especially after the new taxation rules which has applied on debt funds, even balanced and balanced advantage fund as a category has become very attractive, because there you are giving your fund manager the choice to decide your allocation, and you are trusting an expert. So this is something you have to keep in mind. But yeah,
interesting. So that was a conversation that we had not too long back as well. But the hybrid makes sense. But sticking to passive and passive equity, Santosh, I think a lot of people get into this with a fill it, shut it, forget it kind of mindset, where you're putting money on a consistent basis. I think my first guest pointed out that a lot of people are employing that SIP approach. They put lump sums as well. But there can be perils to this, right? Especially in the passive side. The argument, especially in the small cap and mid cap space, is that the active manager can help you protect your downside to a certain extent. How important is that?
Well, to begin with, that entire notion of fill it, shut it, forget it is so good theoretically, but unfortunately, most investors go against their own principles of what they started out with. Now, you asked the question of somebody watching the program for the first time and they do not know anything. For some reason, let's believe that Nifty equal 50, like what Anant said, was a great idea for them. But what's going to happen is they are going to be bogged down by the relative performance of the other funds or the market in general that they're seeing. Then they will question their conviction whether fill it, shut it, forget it was a great idea, because you will see another active fund generating 2% extra return and you feel that you made a mistake by being passive. Because you also have to understand any strategy, whether active or passive, the true test is in your holding period and the returns post holding period. Now, in an active fund, you have at least the objective that the fund manager will at least try in the best of his ability to avoid accidents or mistakes in the portfolio, which you can't, because Nifty is a bunch of 50 stocks, whether equal weighted or not equal weighted. You pick the best and the worst in that group because it's an index. You have no choice about it. In fact, if you did, then your tracking error would go for a toss and then no need for you to be in that kind of a category. Therefore, if investors truly stuck to their own internal mandates and conviction, fill it, shut it, forget it, will work. There again, don't forget the time factor. If you give it 10 years, then it'll be very difficult for us to have this debate saying passive as active, because both will make money. I think we are sure about that. Question is, we do not have people who have 10 months time frame. April 1st to now, we've had a robust 4-5 months. Everybody's asset allocation has gone for a toss because now they're only talking about small cap and mid cap funds. Forget about index and passive.
That's a very good point. And in fact, again, we've had this conversation in the recent past about the outperformance of small cap. And I was speaking to a few people just earlier today about the fact that 20,000 crore or thereabouts is flowed into small cap funds, actively managed small cap funds in the year to date so far. But again, that's a conversation for another day. Let's talk about that tracking error. Anant, you mentioned that tracking error. When it comes to selecting a fund, is this of paramount importance? What else do you pay attention to?
See,
passive, I'm saying.
Yeah, tracking error is important, but it is not the only criteria. Main criteria when you choose a passive fund is to choose the category where you want to invest. Once you have decided the category, you can choose any reasonable fund with more than 500 crores of corpus, a decent name, which has a legacy with legacy to take care of, and having tracking error of less than 0.07%, it's good to go. So you first need to decide on what you want to invest. Then everything will be sorted. Nothing to worry about. Won't make much of a difference.
Santosh, what do you think? So I think when people choose passive funds, the first and foremost concern is cost. They look at the expense ratio and choose the lowest one. But that's not necessarily the best option because you might make mistakes on the tracking side.
See, tracking is one mechanism to tell you whether the mandate of the fund is being honored. Now, in an active fund, you have a lot of measures that you want to see in terms of weightages of the stock, in terms of stock in, stock out, churn ratio. Whereas in a passive fund, you're looking at how the stocks are being replaced or how the stocks are managed in line, almost using like a plumb line for construction. You use a plumb line over here to ensure that the integrity of the fund for which you've got in is managed. Because in a passive, that is the only reason you come in, that you're ensuring that the person in charge of the fund is managing that. Now, that can be measured through a tracking error, saying how quickly, how swiftly they are doing. This changes. But actually, if you think about it, you come to a passive fund, tracking error shouldn't it shouldn't matter. Therefore, if you can, between one or two funds, choose the lesser of a tracking error, you're better off. It's not that because you got a slightly higher tracking error, you'll underperform, because there the underperformance is so small, actually you may not even figure out.
Yeah, you may not notice. So it's a fair point. Anant has already given us his thoughts about which funds can be looked at. Do you have a few names that you can suggest? You've already talked about the Nifty 500.
So I've been always looking at in the passive, how guys are making that entire space interesting. So my favorite, I think I always already told you, was with the Motilal Nifty 500. I think that is a great start for people to begin with, because you don't miss out on the mid and small cap. Even in the passive side, you begin with that journey by getting a full-blown exposure to the top 500 stocks in the country. When you go down the order, I also see that there you got the mid cap 150, mid cap 200 index. You also got, I think UTI has got a nice fund called the Momentum 30 in the top 200 index. What they're saying is that I'll take the top 200 index, but within that, I'll choose only the 30 stocks to be in my portfolio. Otherwise, I think my favorite within the Nifty space would not be the Nifty equal 50 or 50. I would go for the Nifty next 50, because you see there's a constant fight for who gets into Nifty, and the fight is won by the guy who's the best. So in Darwinism, the survivor of the fittest to enter into Nifty will have to only enter there by two conditions. One, he outperforms, or two, somebody in Nifty underperforms.
Fair point. And I think that's a great end to this conversation. Gentlemen, thank you so much for taking the time. Pleasure speaking with you. Viewers, I hope that
Yes,
this helped you. Write to us and we'll get your questions answered. This is BQ Prime.
Thank you so much.
Thanks, Anant. I've been following your work